Good morning everyone and welcome back to Morning Markets here at True Potential. It's Thursday the 16th of November. Today we're going to focus on the inflation stories my colleagues have brought to you earlier in the week. We're going to wrap it up and try and give an outlook for the next 6 months or so. So the inflation surprises we've had this week are important. Firstly, if we focus in on the UK, the surprising fall for the month of October was the last of the base effects as a result of last year's energy price rises. So we shouldn't expect going forward similarly large declines in inflation pressures. However, the trend remains. That is, the monthly gain in prices is slowing and we're likely to see further deceleration in inflation here, particularly through the middle of the winter and into spring next year. And this is likely to give us the phenomenon of UK inflation catching down to inflation in the Eurozone. Inflation in the Eurozone is also trending down. Price pressures there are decelerating quickly. And this, together with the phenomenon in the US of inflation trending towards 2%, is boosting equity prices. And that's what you'll see on screen, where global equity markets have been buoyed by the likelihood of inflation not just peaking last year, but really trending credibly towards 3% and then possibly towards 2% by the middle of next year. And that's more likely to be the case in the US, where core inflation pressures there are clearly decelerating, likely to get towards 2% by the middle of next year. And this really requires central banks to play their part probably from the start of next year. It's likely too early for them to change their narrative. They're still talking about interest rate hikes. They're unlikely to deliver any more, particularly given markets no longer expect any additional hikes in policy rates. However, the trend of inflation this year does require a more nuanced message as we go into next year. So it's likely that by the winter, most central banks will have acknowledged that they have tightened sufficiently and that their outlooks for inflation are more credible with regards to 2% inflation targets. So markets are already looking towards this, looking beyond, and in fact places like the UK are already pricing a modest probability of interest rate cuts by May of next year. The US is similar. So equity markets are feeding off this with strong earnings outlooks and good updates from corporates this quarter. Looking ahead, particularly with the US economic strength, equity markets remain buoyant and are being boosted by the likelihood of the interest rate cycle ending and the possibility, just the possibility of cuts ahead as we go through the middle of next year. So that's all today, a story very much focused on inflation, but please do join us tomorrow where we'll update you again. Thank you.